The bond market is essentially calling BS on Jerome Powell. Just like during the repo crisis, the Fed refused to acknowledge what was going on. Of course, if they made mention of it, the reaction would be wild. So simply playing dumb is the best course of action that they believe. However, the dumb attitude that they have passes on into the financial analysts and others who lay back and relax, knowing that the Fed has given them their SOMA. Sleep tight, little investor. We love you dearly. You came here for the truth, so let me unveil that for you. Today we're going to talk about the bond market. We're going to look at the stock market. I'm going to show you what's going on with crude oil, several indicators to cover. I'm also going to talk about, and believe it or not, passing gas. I'm serious, so hang in there. Let's get into it right away. The bond market rebels as it adjusts to the Federal Reserve's inflation policy. The bond market had a wild ride on Thursday, reacting to the Fed's willingness to permit the economy and inflation to run hot as the job market recovers. Of course, they can show you a 6.2% on the U3 unemployment rate, and the Federal Reserve, Jerome Powell specifically, has acknowledged that the real unemployment rate, that's his words, is approximately 10%. And why? Because the indicator of the U3 is in fact a lie. And the Labor Department has admitted that and suggested specifically that they will not fix it. That's how you know you have extreme criminality right in the faces of people. You look at all the articles that are getting pushed out. You look at all the analysts that talk about it. They continuously reference the 6.2% or whatever it is, the U3 rate at that time, and they will not change. And that to me is just criminal. It's absolutely criminal, knowing that this is not true. The statistic is not true, confirmed by the Labor Department themselves, who are putting this number together, and still it gets put out there and passed on. Strategists say that the market had initially responded to the Fed's dovishness and forecast for no rate hikes through 2023, which I covered in the previous video. By Thursday morning, rising inflation was the top concern. The bond market reacted dramatically to the Fed's policy to allow it to run above its 2% target. Something interesting about the 2% target is that they haven't been able to achieve it at all. In fact, inflation continues to decline as they measure it. We're talking about that core PCE rate, this nonsense rate that they have created, which basically eliminates everything from it. So, hey, of course, inflation is going to be really low. Just keep taking stuff out. If it goes up in price, just take it out of the equation. You don't have a problem anymore. I will cover that more in a minute. But the reason I mention this is we cannot trust their statistics in the way that they put it out. So I have been talking with all the different subscribers. I have been noticing this from people directly. I have been paying attention to the statistics, and it is very clear. You look around, the price of basically everything is going up. It's going up fast, and there's no way to deny it. It's not just lumber prices, but certainly we've seen it there. And it's not just the stock market, but it's healthcare, it's tuition, it's all of these different things that people may or may not have to purchase right now. And that is what when we know we have an issue, that it's not just let's say commodities. It's not just the stock market. This is the everything bubble. 10-year Treasury yield climbs above 1.7% for a 14-month high. 30-year rate briefly tops 2.5%. The Fed expects core inflation, there we go again, to hit 2.2% this year, but has a long run expectation of it sticking around 2%. Yes, don't worry, they're going to be able to do so. They are still printing the $120 billion of bonds. Jerome Powell had made this clear. I covered it in a previous video talking about how 120 is where they're going to stay. They're not going to increase. They're not going to decrease. You've got until at least all the way through 2023 to worry about any rate of interest hike. That's not going to happen all the way through the next few years. Of course, back in 2007, 2008, 2009, and 2010, the Federal Reserve also said there was no problem with the housing market all the way through. It's like they want to just spit in your face and you're willing to accept it. You just see a lineup and the Federal Reserve says, come and get your free money, let's say. And then people just line up and you see one after the other. people, they're just spitting in their face and sending them off. And the next guy, okay, well, sure, I'll take free money. Oh, spit in the face. This is the way that they treat you. And unfortunately, nobody seems to care. It's a lie and a lie and a lie. Why? Because they got the printing press, they're controlling everything, and they just hope the Federal Reserve isn't going to let me down. I mean, they really care about me. Sure, they were set up in secret. Sure, it's all the biggest bankers in the world. Oh, sure, it's a private institution masquerading as there to help people. Oh, sure, they lied about the $16 trillion bailout. Sure, they would not actually allow people to know who they were giving the money to. Sure, we don't know who that money when it went out, who actually got it back, where does it go? Nobody knows any of these details, but don't worry, they've got your back. Here's the 10-year Treasury yield 1-year change, and you could see essentially just showing you the reversal of the trend. Since approximately August timeframe, it has been heading higher. This is just giving you a comparison, the 10-year real yield on the inverse, and then spot gold. Of course, we can see what has been happening through March, where gold has been moving higher, and it's been one of those certainly different timeframes where, yes, now that the inflation expectation has been moving up, so has gold. But gold had been something that, despite the maximum amount of risk that was going on throughout 2020, so much uncertainty, gold didn't perform as well as something like stocks. Although it did do, it did move up a fair portion from that area where it was at previously. But the point I'm trying to make here is that these are somewhat correlated right now, and we'll see if that moves apart. All I want to note is, quite frankly, that when we have the risk on, when there is actual failure that starts to happen, that's when gold performs the best. Sure, it fluctuates up and down, but it's when there start to be an actual really serious level of failure, that's when it will skyrocket. It goes up so fast. And if you remember in the previous bull market, it's probably about a decade ago, if you looked at what happened right at that peak, there was so much of a shortage that it was impossible to find the physical metals. You would line up, they would have very, very limited selection at any of these places. And that to me was a sign that finally the demand was there. Who knows what people have done with those physical metals? Have they sold it off? Probably not much of it. The paper metal, definitely a different story. This is the copper gold ratio, and you could see what's going on with the 10-year yield. These were all throughout 2019, they were mirroring each other, and now that broke apart essentially. So will they come together again? Well, only time will tell. This article here is basically bowing down to the Federal Reserve, but I just want to note something at the very bottom of it. Rather, it's a reminder that bond traders pushing the 10-year yield higher isn't some sort of existential crisis. Yes, it's a global borrowing benchmark, and it's used as a risk-free rate to value a range of financial assets. But it wouldn't take all that much for Powell and Yellen to simply turn the entire yield curve into something resembling the overnight rate set by the Fed. With that kind of power, it's little wonder that they tune out the day-to-day tantrums. Of course, this is not a day-to-day tantrum. This, just like the repo crisis, is a consistent trend. They ignore it on one hand, but quite frankly, they know exactly what's going on. The bond market, is not fooled by what they see in the day-to-day noise created by the Federal Reserve. The bond market simply does what it does. Take a look at crude oil WTI specifically. This moved up $66, came down to $60. It was definitely hammered at this point here. And the reason that I think people should be paying attention to what's going on, not just with certainly the volatility that's there, but the fact that it is such an important important commodity, and perhaps in some cases you can look at it as being a leader in with the rest of the commodities. Of course, you see how much of business, how much of all these different transactions out there, imports and exports, and things moving in and out rely on this commodity. It is so important. So when you see the price rise, you better pay attention. This is a really good article. I'm just going to touch on a couple of the charts that I found in here. Now, out of Bloomberg, they suggest, once again, we've heard this many times, we may be entering a new commodities super cycle. It's not the first time I'm talking about it on the channel, of course, but you need to be prepared for this because already prices are so high. To me, look, there's two sides. There's the investor and there's the consumer. And we need to be paying attention to how this affects people's bottom line. That's the most important thing, especially when the consumer in the United States is 70% of the economy. Rising commodity prices have bank analysts and strategists asking if resurgent demand for raw materials and insufficient supply will create a new commodity supercycle. Price swings, of course, are as old as the business itself. A commodity supercycle is different, though. And then they basically talk about that. And I would recommend that people check it out if you have the time. Start of a new cycle. Here you can see the Bloomberg Commodity Index. It started to bounce off this bottom that we haven't seen for a long time and has surged up higher. We'll see what happens there. You can look at the big money, oil and gas sector capital expenditure, showing us that this is definitely down from what we saw from the previous years. But why? Because there was such a shutdown, the slowdowns, and so on. Will 2021 be that resurgence in what had happened in previous years? 2008 obviously was just starting to get in there. The consumption was peaking out right around, it looks like 2013. I just find it interesting to see what's happening with oil in general because there's so many different businesses that rely on it. Available bandwidth, OPEC, oil production spare capacity, and that has come off the peak certainly, but this is something that obviously affects the price to a great deal. They get into more here, going electric, global passenger electric vehicle sales. This is certainly increasing year over year, particularly as they have their incentive programs. If those are there, people are going to buy into them. And that's clearly beneficial for certain companies, not just Tesla, but now all of the big manufacturers are going in that direction. So I think people, investors, should be paying attention to that. They talk about energy here. Of course, they've got food as well. This comes directly from the BLS, 12-month percentage change in the CPI, the Consumer Price Index. All right. So you can look right here at food, and it's right around, I would say, 3.5%. 3.5%. Now, the way that they do these is a little bit ridiculous, actually, but you can just see that it has increased far greater than what they put into, and I love this, all items less food and energy. Hey, you can get it down to, what is that, 1.3, 1.4, let's just say 1.35. And that's no problem. See, that's where the inflation rate is right now, because they just say all items less food and energy. When these two things are increasing, you don't have a problem. Now, all items still not even at that 2% mark. And the way that they manipulate this is, as far as I'm concerned, criminal. But the reason I mention this is that even the rate of 3.5% on food is too low. It's too low. And you tell me, wherever you are today, tell me what you think food year over year, what the percentage of increase has been. Goldman's junior bankers complain of crushing workload amid SPAC-fueled boom in Wall Street deals. They're basically saying they're tired, they can't handle it, this is ridiculous, 100-hour weeks, this is unbelievable. And why? Because there's so much money flooding in. They need to take it all, and they're going to make a lot of money from it. That is the Goldman Sachs and all of the big institutions. Not the average individual working, that's for sure. They're going to make whatever they can get because they want to make it up the food chain. That's the way it works. But SPAC, this is interesting because we can see that there is an unlimited amount of money out there, it seems, with the Federal Reserve and the global governments are just going out, they're pumping money in left, right, and center, and that is starting to create some very, very wacky trends. One of them are the blank check companies, and this has truly gotten out of control. I wasn't kidding. I really wasn't at the beginning when I said we would talk about passing gas. New York City man sells fart for $85, cashing in on the NFT craze. So I just briefly scrolled through it, and basically what happened was this person was recording his own passing of gas. They put them into these files, sold them off. You can buy the whole lot of them, or you can buy just one. And apparently one person decided to buy one of them. This is when you know you've reached a peak. Or do you call it a low? That's all for this video. If you found it informative, hit that thumbs up button. When you do, you're supporting me. I want to thank you for that. If you want to learn about e-commerce, you can do that for free at the AmazonGPS.com. Have you seen my 2 books? These have everything you need about the financial system, and they're explained so simply, so easily. So definitely check them out at the link in the description if you want the audiobook. That's available at themoneygps.com. If you have not seen this video, you absolutely want to take a look. Click it, and I'll see you there.